April 2026, US stocks just smashed all-time highs, and retail investors are celebrating. But here is what they are missing. Institutional money is not buying the indexes anymore. Wall Street is quietly rotating into 5 specific stocks before next week's earnings catalysts detonate. This is the smart money versus dumb money playbook unfolding in real time. Let me show you exactly what the institutions see that you do not. First, the macro setup. The Strait of Hormuz just reopened temporarily, and oil prices collapsed. WTI crude dropped over 8% in a single session. That is deflationary pressure hitting energy sectors hard, but it is rocket fuel for consumer discretionary and tech margins. Institutions are front-running this margin expansion trade before earnings confirm it. Second data point, corporate earnings are accelerating into the heaviest reporting week of Q1 2026. Big banks already reported, and the beat rate is sitting above 75%. But here's the institutional edge. They are not chasing the names that already reported. They are loading the names reporting next week with the highest positive earnings surprise probability. That is where asymmetric risk-reward lies. Now let me decode the 5 stocks Wall Street is accumulating right now. Number 1, a mega-cap tech name with cloud infrastructure exposure that benefits directly from falling energy costs. Number 2, a financial services play with international exposure that profits from geopolitical de-escalation. Number 3, a consumer discretionary giant that is about to report blowout margins thanks to collapsing input costs. Number 4, a semiconductor name that is oversold into earnings despite supply chain normalization. Number 5, a healthcare innovator with FDA catalysts aligning perfectly with this earnings window. I am not naming them outright because this is institutional grade analysis, not a stock tip channel. But if you cross-reference the sectors I just mentioned with next week's earnings calendar and the macro tailwinds I outlined, the tickers become obvious. Now let me give you the ETF level strategy if you want sector exposure instead of single stock risk. For tech margin expansion, look at XLK or SOXX. For consumer discretionary benefiting from lower oil, XLY is your play. For financials with geopolitical upside, KRE or XLF. These are not random picks. These are the exact sectors institutional desks are overweighting right now based on April 2026 macro conditions. Here is the historical parallel you need to understand. This setup mirrors early 2009. Markets hit new highs after a major geopolitical crisis eased, oil prices collapsed, and earnings season became the catalyst for the next leg up. But here is the trap. In 2009, retail investors bought the indexes at the top while institutions rotated into specific value pockets. 6 months later, the indexes stalled, but those specific sectors and stocks ripped another 40%. Institutions made the real money, not the index chasers. That is the game being played right now in April 2026. So here's your action plan. Stop chasing the SPY at all-time highs. Start mapping the 5 stocks and 3 ETFs I just outlined against next week's earnings catalysts. Use options flow data to confirm institutional positioning. And remember, smart money does not buy what is already expensive. They buy what is about to become expensive. That is the edge. This is not financial advice. This is institutional grade macro analysis for educational purposes only. All investment decisions carry risk, and you must do your own due diligence.